You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball. I'm joined today by my co-host, John McEwen, and it's the 28th of March, 2023. In this week's episode, we'll be discussing Fevertree, Keyword Studios, Inditex, Helios Towers, Kingfisher, and our US-listed stock of the week is Coca-Cola FEMSA. John, do you want to kick us off with favourite of the show, Fevertree?
Yeah, Fevertree. So it's the AIM-listed tonic and soft drinks maker that we've covered quite a few times now. They had their full-year results out, with full-year revenues growing 11% to £344.3 million. They had double-digit growth in the US, Europe, and the rest of the world, and more than offset a 2% decline in the group's core UK market, which still accounts for around a third of total revenues. Underlying cash profits, EBITDA, fell 37% to £39.7 million, as margins fell from 20.2% to 11.6%, reflecting inflationary headwinds, especially the impact of higher energy costs and continued investment in the business for growth. Free cash flow fell from £43.2 million to £3.9 million, mainly due to the lower cash profits this year and an increase in the US inventory levels to ensure that the group can meet their ongoing demand in this market. Net cash also fell from £166.2 million to £95.3 million. The group remain confident of delivering strong growth this year and have reiterated full-year revenue guidance of between £390 and £405 million, which represents 13 to 18% expected growth. Full-year EBITDA is expected to be in the range of between £36 and £42 million. A final dividend of 10.68 pence per share has been announced, and that's an increase of 2% on last year. The shares rose 7.8% in early trading, and in terms of the current valuation of Fevertree, with a market cap of £1.4 billion, it trades at 48 times forward earnings, which is broadly in line with its 10-year average, and it currently yields 1.5%. I thought these results were mixed. Clearly very good revenue growth, but it's not all feeding through into profits for some of the reasons that they outlined. We've talked about it before with the inflationary pressures and energy costs hitting the business. 80% of their product has been made with glass bottles, which is very energy intensive, not to mention the delay in the ramping up of production at their East Coast US bottling plant. And I suppose these problems aren't looking like they're all going to be resolved in 2023. So I think things are going to be still fairly bumpy yet. I think the biggest difficulty is that really toppy valuation of nearly 50 times forward earnings. And it is priced as though it's going to dominate the world. And we're still really quite far off that, even the US. So I think it is really quite high risk. I do like the business, but I'd be very nervous about paying up for, paying nearly 50 times earnings for it. That's my biggest anxiety. I think there are a lot of uncertainty still there. But I suppose if you did have that very long-term view and you were very bullish and you did see it dominating with its tiny market cap, it could be a multi-bagger. But I suppose, are you prepared for that level of risk? Are you, Sam?
I actually don't think it looks that bad. I'm going off, this is very back of a fag packet. I've not looked at the detail in the differences. But free cash flow is down from 43.2 to 3.9. Now, earnings won't have dropped by the same amount, but due to the cost increases, it's 48 times earnings, but they are artificially low earnings. If you think they can get the operating margins back to where they've historically been, because a lot of the problems like with glass bottling and stuff, you would hope as supply chains ease up and stuff, and they are getting better, that starts to move back to how it previously was. And it did have very good margins for a drinks maker. I think Fevertree is a very, very strong brand. At least in the UK it is. Certainly if you go with anecdotal evidence. I would back them to get back to those level of operating profits. Or not operating profits, operating margins. I think John's counter would be, well, yes, but if they got back to that, it was still expensive then. So you may be going from like 50 to 25 or 30. And that's possibly the issue I have, because it's still expensive, even if you assume it's going to get back to normal. So it does take you back to the same point where it's like, yes, it can't just do it in the UK, it has to do the international. When you look at the international, it all looks quite good. I think really the market that you're the most concerned with is US. And US looks very positive. There's not really a leader in that market because they're basically having to go out and create the market and premiumize a market that's never been premiumized before. When you look at how it's going, where they're having to like what you're saying about the inventory, where they're having to stock up for growing demand in the US, that does look very positive. So if you can go out and say, well, actually, can they go and do what they've done in the UK and the US? If the answer is yes, I think it's really, really cheap. And then when you look at the share price as well, it's down at £12 a share now. In 2018, 2019, it was as high as, it was over 35. So it's a lot less expensive than it used to be. I think if you think it's going to crack the US, I think it's cheap. My issue is I'm not certain enough that I would be willing to pay 48 times earnings, even if I viewed it as these are artificially low. So I'm actually getting it at 25 times earnings. I'm still not sure I'd be comfortable paying that. It's a business where every time we look at it, I do like the business, but I just think I'd really like to see this get cut in half. It's not cheap enough for me where I'd say, yeah, I'm going to have a proper look at this, but I do really like the business. And I understand why if someone was absolutely certain about them cracking America, they might feel differently.
I suppose I don't know enough about the American market, and yeah, probably need to do some research trips over there.
Well, it's hard though, because it just doesn't actually exist. Because there's no it's not like you're saying, well, they're going to go and take it off this like, you are relying on them to go out. Whereas like if you compare it to say Boohoo, where you know the market's there and it's like, well, if they can crack it, there's so many sales that can head their way. And you look at the size of the market, they've got a lot more competition, but you know the market is there. Whereas with Fevertree's position, they might not actually, the Americans just might not take to it.
Yeah. Honestly, I don't know.
No.
I mean, I certainly don't know enough to be backing it at nearly 50 times earnings.
No, me neither.
Keyword Studios.
Yes, so it's a business we've covered before. For anyone who's not familiar with the business, it's basically an outsourced supplier for the gaming industry. So a lot of the things gaming companies will do when they're building a game, they will outsource a lot of those functions to Keyword Studios. I won't go over them in detail because we have covered them on previous episodes where we've covered the show. It's also another AIM listed one. I think it's the last AIM listed one we're looking at this week, but we've had a little bit of an AIM special for you. So Keywords have come out with their full year results, and full year revenue grew by 34.8% to €690.7 million, and all these figures are in euros, in line with recently raised guidance. This reflected strong organic growth, positive changes in exchange rates, and contributions from acquisitions. Keywords also said it's benefiting from a continued trend towards outsourcing. Underlying operating profit came in at €114.6 million, an increase of 29.6%, slightly ahead of management's expectations. Profits rose at a slower rate than revenue because of the exit from the Russian market and costs associated with a return to normal work patterns after lockdowns. The outlook for 2023 remains unchanged, with organic growth expected to moderate but remain above medium-term guidance of over 10%. Underlying free cash flow was up from 92.3 million to 112.1 million, but net cash fell to 22.8 million from 81.8 million, reflecting continued spend on acquisitions. Shares were down 6.5% on the results. It's also interesting that they're the market leader for, I guess you'd call them the outsource gaming industry market, but with only a 6% market share. So there's a lot of opportunity for growth. You could take the flip side and say it was clearly a very fragmented market, so it's probably going to be very difficult to grow, but I guess it depends how optimistic or pessimistic you are. And they're also in the early stages of expanding into adjacent markets such as subscription gaming, media and entertainment, and the metaverse. I feel like that announcement was probably about 18 months later than it should have been, because
Yeah.
the shares would have got a nice pop on that 18 months ago. In terms of valuation, the business trades at a forward P of 26.9, and that compares to a 10-year average of 28.8, and the prospective yield for the next 12 months is 0.1%. So these are, well, fantastic results, I think. Really interesting business, quite an exciting business to actually have in the UK. We don't get many businesses like this. You do have to pay up for it. But from a very quick scan, when you look at these results and you look at the history of the business, so 2018 to 2022, so this is a 5-year period, revenues increased from 250 to 690 million, and the operating profit shot up from 22 to 71 million, and earnings per share up from 23 cents to 61 cents on a basic basis, diluted at 22 to 58 cents. It has been putting up the numbers. So I guess you could say, well, it's quite a young market. It's quite an exciting market. There's only, market leader, but only a 6% market share. It's putting up very good growth figures. Some of it is finance. It's partly due to acquisitions. But I can see why someone might be willing to pay 26.9 times earnings for this business. I'm just not sure I would be. John, what are your thoughts on the business and the results?
I mean, it's like you say, it's an exciting business in the UK. It's on the back of a growth industry. I'm liking it the more we're looking at it. It's not the type of business that I would normally buy, but 34% revenue growth. And it's certainly not cheap at 26 times forward earnings. But would I back it? Possibly. 6% market share and market leader. I appreciate it's a fragmented industry. But yeah, like you say, it's been putting up the numbers.
Good enough for the watch list?
Yeah, definitely good enough for the watch list. And it's interesting as well because it's in that AIM category or on the AIM listed. But yeah, definitely good enough for the watch list. And it's one of the bigger market caps on the AIM of about £2 billion too. Yeah,
market cap's 2.08 billion. So you were spot on, actually.
Yeah, so no, one for the watch list.
Ooh, right. Shall we move on to another watch list stock of yours?
Yeah. Shame I haven't bought shares in it yet. Inditex, and it's most famously the owner of Zara, although there are some other fashion businesses that it owns, or fashion retailers, I should say. They saw their full year sales rise 18% to 32.6 billion euros, ignoring the impact of exchange rates. And in-store revenues accelerated considerably faster than online sales. Inditex enjoyed double-digit growth in all geographies. Opening income jumped 29% to 5.5 billion euros, and this was thanks to the sales growth outpacing a 15% increase in operating expenses. Free cash flow fell from 3.5 billion euros to 3.2 billion euros as the group continued to invest in its store space. The group's net cash position grew 8% to 10 billion euros. And Inditex commented that it sees strong growth opportunities in a highly fragmented market. As such, it will continue expanding with gross store space set to grow 3% in 2023, whilst gross margin should also remain stable. The group announced dividends of €1.20 per share for 2022, which represents an increase of 29%. Shares were down slightly on the announcement, but in terms of the valuation, it has a massive market cap in Spain of 91 billion euros and trades at 21 times forward earnings compared with a 10-year average of 25, and it yields over 4%. I thought these results were really fantastic, and its strategy of integrating its online and physical store inventory, giving it better supply chain visibility, seems to be working well and keeping excess stock to a minimum. It's also kept pace, or I suppose it almost sets the pace after new trends are released on the catwalk to getting them onto the high street. And its balance sheet is very healthy with a net cash position of 10 billion euros. It's certainly not cheap, but it is delivering the numbers. And I suppose the question I would pose to you, Sam, is do you think it's worth the premium over Next?
I think these are probably the best results I've seen from it. especially when you go and look at the past 6 years of results, 2018, 25 billion euros. 2020, it had gone up to 28, dropped to 20 and 21 because of COVID, and then it came back up to 27. So last year, it had a very, very good year, but it was kind of like, well, it's just getting back to where it was, and it's benefited from very weak comparatives. This year, it's smashed it, and it's by far the best year of the last 6 years. The previous high of 2020, 28 billion, 32 is well above that. It's a really, really solid year, and I wouldn't have expected them to have a year this good. I don't really like the industry. I know you compared it to Next, but I think Next is, at least they've got like the homeware and stuff. And I think Next is a bit more than just clothing.
I would say that Zara does have Zara Home, but it is.
Does it?
Yeah, it does. But in terms of sales, it's nothing like Next as a proportion.
All right. Well, I actually didn't realize I don't shop in Zara, so I stand corrected on that. But yeah, it's like it's saying as well, it's the in-store revenues accelerating considerably faster than online sales. I would argue that Next has higher quality revenue because it's really utilizing the online properly. I don't think Next is anywhere near as much at the mercy of like fast fashion and stuff. I think Next, I would prefer Next as a business. And then you've also got with Next the potential of them sort of, doing where they're taking their where they're basically selling their know-how on how to do the logistics to other businesses. Yeah. That's quite a nice little add-on. I quite like that. So I think Next is genuinely, I prefer it as a business. I don't partly with Inditex, I just don't like the industry. I don't know if it's because I've been scarred so much by Boohoo, but I definitely wouldn't put another retailer in my portfolio. Yeah. Whereas I would consider putting Next in there because I just don't quite view it. I was very, very close, I think about a year ago or something, to pulling the trigger on Next. So I was like literally hovering over the buy button, and then I just didn't do it in the end, to my regret. But
Next are actually reporting tomorrow, and the share price is pretty much static from a year ago. So,
I must have got the date wrong. Whenever I looked at it, it's up about 20-25% since then.
Well, when you looked at it, it might have been October time. It was down in the doldrums then, and it's up a lot. It's up nearly 50% since then.
That's probably it. It's definitely up since I was very close to buying it.
In which case, you'd have timed it perfectly.
I would have. Instead, I timed it horrifically.
Yeah.
But anyway, so yeah, I think these are really impressive results. It's a very impressive business, very good dividend. I'm not sure about the 21 forward PE for a business in this industry of this size, but in terms of the business, I can't really criticize it. It's just not for me. What about you, John?
I mean, I like the results, fantastic, but probably not. And even Next, I do like it, and I think there's probably a greater margin of safety with it, but still, it's the industry, I think.
So pretty similar there, because I always felt like with Inditex, you were always closer to me than actually buying it, but you just wouldn't buy it because of the industry.
I think the industry, but I do.
What about ABF?
No,
because that's more diversified.
It is more diversified. I think maybe it would be more partly the industry, but then opportunity cost would come into it. They're not businesses that I really love.
You've got Primark potentially cracking America though at ABF.
I know, and we've got.
I know, but every British retailer's trying to crack America.
That's right. And like Diageo, for example, I know it's not a retailer, but that is genuinely cracking America. And yes, it's not a cheap stock, but that's a company that I really like.
Okay.
Yeah.
I mean, to be honest, I probably wouldn't buy Boohoo again. It's still in my portfolio, but I don't think I'd buy it.
We'll have to, when are their earnings?
I'm not sure. It's doing all right though. It's over 50p now.
Yeah.
Not only over 40% or something to go to break even. It was down like 70% at one point. So. Anyway, what are we on next? Helios Towers, a debut.
Yes.
Helios Towers, it's the debut on the show. I will first start with what the business does, and this is all red. There will actually be a cameo for a business we know and love, and it won't take you long to guess which business it is later on. But anyway, I'll start with, this is the investment case, and do take it with a pinch of salt because it's from the Helios Towers website. But why invest in Helios Towers? Helios Towers offers investors a unique combination of growth and quality. We operate a geographically diverse suite of telecommunications towers with a highly visible base of contracted revenues from blue-chip mobile operators and hold leading market positions in the world's fastest-growing mobile markets. We are a leading mobile telecommunications infrastructure company, uniquely positioned to capture the growth in mobile communications across our sole region of focus, Africa and the Middle East. We have a leading position in 7 of our 9 markets, have strong customer diversification and a well-invested platform. Africa and the Middle East is the fastest growing region for mobile globally, driven by low mobile penetration today and huge population growth. In fact, by the end of this century, the region will be the most populous globally, outpacing Asia, with the rest of the world seeing fairly flat population levels. Accordingly, over the next 5 years, it is forecast there will be 63 million more mobile subscribers in our markets of operation. The infrastructure requirements to support this growth is huge. 25,000 additional points of service forecast, which is larger than our tenancy count today. At the same time, there remains huge inorganic potential, with 280,000 towers still held by mobile network operators. It resembles Europe 5 to 10 years ago and the US 15 to 20 years ago, and we are well established as a leading operator in the region. Operating towers in Africa and the Middle East is different to the rest of the world. Mobile operators look to partner with towercos that have proven operational capabilities in terms of effective maintenance and the highest levels of power uptime. We have talented local workforces in each of our markets to help our people and our business reach its full potential. We have a focus on business excellence and deliver best-in-class customer service. We have already achieved 99.97% of power uptime in 2022, representing 1 minute downtime per tower per week, with further targets to lower downtime to 30 seconds per tower per week by 2026. We've built a business that delivers high-quality earnings. Over 70% of our EBITDA is hard currency, and we have a diverse set of investment-grade or near-investment-grade customers. The maximum single customer exposure stands at 28%, and that 28% is our very own Airtel Africa, by the way. And 98% of our revenue comes from blue-chip MNO customers. We're the most geographically diverse towerco across Africa and the Middle East region. Combining these factors along with a US towerco-style contract structure, minimum cancellation rights, long-term, embedded CPI and power escalators means we have a highly visible base of earnings upon which we can layer the organic and inorganic growth opportunities. So that's what the business does. Basically, I'm assuming everyone at this point who's been listening to the show for more than a few months know what Airtel Africa do. They are one of the leading mobile operators in Africa. So what Helios Towers do is they actually put the infrastructure in and they lease it to Airtel Africa, and Airtel Africa then goes and sells that to the end consumer. So you may have seen at some points when we've covered Airtel Africa in the results, we may have mentioned Helios Towers, because I think sometimes they've been selling towers to Helios and leasing them back, for example, which just allows Airtel Africa to have a more capital-like business model. So Helios Towers, as well as Airtel Africa, actually, which I find slightly odd, but Helios Towers are also listed on the FTSE. They're FTSE 250 listed and have a market cap of £1.08 billion. And looks like they listed at a similar time to Airtel Africa, actually. It was about 2018. I wonder if there's any link. I didn't. This is the first time I've looked at it, but I'd be interested to know how the company ended up on the FTSE. If someone knows, please do tweet it in, by the way, and I'll retweet it because I'm lazy. But I would be very interested to know why they both ended up listing on the FTSE at a similar time period. Anyway, they have come out with their full year results, and this is for the year ended 31 December 2022. The number of sites they operate was up 42% to 13,553. The number of tenancies was up 30% to 24,492. The tenancy ratio was down 0.15x to 1.81x, so they must have more than one tenant per tower. Revenue was up 25% to $560.7 million, and all the figures are in dollars. Operating profit was up 36% to $80.3 million. Free cash flow from the tower portfolio was up 20% to $201.4 million. Cash generated from operations was down 1% to $193.2 million. Net debt was up 77% to $1.678 billion, and net leverage was up 1.5x. From 3.6x to 5.1x. And in the slides, we highlighted that in the 2022 year, there was $765 million of capex, including their acquisitions in Oman and Malawi. 2023, they're expecting lower capex of 170 to 210 million, and they're focused on an organic rollout instead. This was more interesting, actually, from the perspective as an Airtel Africa shareholder, but they've highlighted some stuff about the African market. So low mobile penetration in Helios Towers markets, of which there is a significant overlap with Airtel Africa. They have 51% mobile penetration, and that compares to 91% in G7 countries. Between 2021 and 26, they're expecting population growth of 42 million, and that's compound annual growth rate of 2%, and that compares to just 7 million for G7 countries, which is a compound annual growth rate of about 0%. They're in the fastest growing mobile markets. From 2021 to 26, they're expecting an increase of 68 million customers, so that's a compound annual growth rate of mobile users rather than customers, but a compound annual growth rate of 4%, and that compares to just 1% in the G7. So in terms of the customer base, 28% of their revenue does come from Airtel Africa. There's another 24% that comes from Vodacom, and then the next biggest is 13%. As mentioned before, what's happening is Airtel Africa and Vodacom, they are leasing the infrastructure to operate in the countries they operate in from countries like Helios Towers. In terms of the debt, so they've said the net leverage increased by 1.5x year over year to 5.1x due to the closing of the Malawi and the Oman acquisitions. Excluding Oman, net leverage was 4.1x, which was around the midpoint of the target range of 3.5x to 4.5x. They said they have ample liquidity with 120 million of cash on the balance sheet and approximately 375 million undrawn debt facilities across the group, a total of approximately 495 million in available funds. The average weighted lifetime remaining on the debt is 4 years, and they've said that 83% of the debt was drawn at fixed rates of interest. So it doesn't look like the worst kind of debt in the world, but I would say at those levels of debt, I would find it very uncomfortable. 5.1x is just far too high. In terms of the valuation, the business trades at, it's actually got a loss per share this year, but they've adjusted to give you a PE of 4.65. However, I do take those kind of adjustments with a pinch of salt. I think this is an interesting company. I think the debt's just too high for me. I much prefer Airtel Africa's model where they're moving away from debt. And if you look at the amount the Airtel Africa debt's come down in previous years, it's just so much lower. And as well, like the majority of the debt they do have, it's to the parent company anyway. So it's not a significant risk to the business in any case. So I'd much rather be. I'm quite happy. I think this is an interesting business. It's been quite interesting to look at. But looking at this, it's as an Airtel Africa shareholder, I'm not sat here thinking, oh, I wish I'd seen this first. But yeah, interesting business, but I'm not comfortable with the debt. I also don't like the business model, to be honest. I think it's too capital intensive. I suppose you could get the old picks and shovels argument out that, in a gold rush, you're better to be the person selling the picks. But I think it's just a very capital intensive business model. And it's just not something I typically look for. So it's just not for me, but interesting company. John, your thoughts on the results in the company?
Yeah, similar. I think it's a very interesting and exciting business in the regions and the industry that it's operating in. I do prefer what we own, I suppose almost the capital light end of the business, or certainly what it's become with Airtel Africa. It might be one in a few years' time that it's in a healthier state and the growth is materializing, and that we look back and maybe it would be investable at that point. But at the moment, I don't think it is investable. And yeah, like you say, the levels of debt are worrying, particularly as debt is becoming more expensive too. So yeah, I would leave it alone, but an interesting one nonetheless. And I'd be keen to keep following it.
No, well, it's one that I think I've seen it before when we look at the lists, and I've never really appreciated had I known what they were doing and where they were doing it, I probably would have covered them sooner. We actually got a listener ask us to take a look at it about a week ago, or we had a listener message us on Twitter asking if we'd ever looked at it. And I said, no, we hadn't. But, if they do have a look, let us know what they think. And then when I was looking at the list this week and when we were discussing what to cover, it was one that had reported. So I was like, oh, well, I may as well just take a look. So shall we move on to a business that we've looked at multiple times before?
Yes, and one that you do like. I mean, it's certainly grown on me too. Kingfisher, the owner of B&Q and Screwfix, had its full year results out with a sharp decline in profits, with adjusted pre-tax profit falling 20% to £758 million, in line with guidance of between £730 and £760 million. Sales fell by 0.9% to £13 billion, with sales of big-ticket items like kitchens and bathrooms flat. On a like-for-like basis, sales were 2.1% lower, but 15.6% ahead of pre-pandemic levels, with the working from home trend continuing. More than £1 in every 10 it made last year came from energy and water-saving products. The group said its performance reflected strong prior year comparatives linked to high demand for home improvement products. Going forward, analysts expect adjusted pre-tax profits of £633 million and a 2.7% decline in like-for-like sales, with Thierry Garnier, the chief executive, saying expectations of lower profits reflect pressures on consumers, higher energy and staff costs, and a hit to profit coming also from a slowed expansion in France. The company maintained its total dividend of 12.4 pence per share and intends to announce a new share buyback programme after the completion of the existing £300 million buyback this year. It's aiming to raise its online sales from 16.3% to 25%, and it's investing in its online e-commerce platform. In terms of valuation, Kingfisher has a market cap of £4.8 billion and trades at 11 times forward earnings. It's difficult. I think these results were certainly what was expected. Still a bit disappointing, but you probably saw that artificial boom that was brought on by COVID and the working from home, a lot of which is sticking around. But you've also got the large cyclical element to Kingfisher with the links to the property market, discretionary spend, home upgrades. And we are in a tough time, cost of living crisis in the UK. So I think it is going to be a difficult couple of years, but I think Kingfisher is generally a fairly healthy company, certainly compared with a lot of other retailers like Halfords, for example, another one which had been a lockdown winner. It wouldn't be one that I'd be going out to buy, but nor is it that expensive at 11 times forward earnings. But I think it's a bumpy time, and I think there are probably higher quality businesses out there that I'd much rather own than Kingfisher. I think that's probably where I'd leave it. Sam, your thoughts on Kingfisher and these results?
I'm surprised by these results, actually. I thought it would be more resilient than it had been. Yeah, I guess you have a lot of people. It's easy to look back at hindsight and come up with reasons why this has happened. But I guess you've had a lot of people, for example, that have been doing lockdown projects when they're locked in, and now they've got they've got the new kitchen, they've got the new bathroom, and maybe a lot of stuff's been pulled forward 2 or 3 years. But even still, like when we've covered, sometimes we've covered this business and we've gone into a bit of detail, and they've got like quite decent sized operations in other parts of Europe. Like I think they've got Poland and they've got France and they might have like a Spanish or a Portuguese one as well. But they've got lots. So you sort of think, well, if they can be growing there as well, I am surprised how much it's dropped off. And I don't know. I think it is quite disappointing because I thought it was a higher quality business. It might be that they bounce back and it's almost like they've had the growth pulled forward and now they've got the bad year and then they can go back to sort of where they were. I suppose the only saving grace of it is even it was priced like a cyclical, even towards, what looks like it may have been the top, but at least it was never that expensive. I mean, we were covering it at, what was it, like 6 or 7 times earnings?
Yeah.
And now it's dropped to 9?
Yeah.
So it's dropped, but it's not that bad. It could have been a lot worse. So I suppose at least it's been pretty cheap throughout. It's not like you bought this thing at 50 times sales. But I am surprised by this. I thought it would have held up better because there's other businesses we've seen, like for example, like B&M. They had a very good lockdown, and I think they've done all right holding on to it, or at least they've not had anywhere near like the drop off Kingfisher has, and a few of the others we've looked at, they have held on to it all right. So it is a disappointing, I think.
Yeah, and the share price down about 5% in a year, so it's not massive.
No, but then you go back to what was the COVID high though? It was over £3.50, so it's down.
Oh yeah, it has pulled back a lot since.
It's more like 40% from then. But it's still got a good yield as well, nearly 5%. I just think maybe it's maybe just not as high a quality business as I'd possibly given it credit. Or it might just be a cyclical. I might have just completely misjudged it. And it's actually just a cyclical. And, if you look at what the house builders have done since we've covered them in the last 6 months, it's pretty in line. So if you view it as a cyclical, you do almost have a very different perspective on it. And it's got a cyclical kind of dividend as well. So
it does, yeah.
Maybe I just categorized it wrong.
Yeah, I mean, it's tricky, isn't it? But
yeah, should we move on to a business that's much easier to understand?
Yes, you go for it, Sam.
Yes, Coca-Cola FEMSA. So we did our Coke special a few weeks ago, where we did Coca-Cola, Hellenic Bottling Company, and Daddy Coke on the same show, and we had a listener say, "Well, if seeing as you like Coca-Cola Hellenic Bottling Company because it covers all these emerging markets, have you ever looked at Coca-Cola FEMSA?" So I had a look, and the answer is we haven't. We did once look at the Australian Coke, like the Asia Pacific one. We have looked at that one, but yeah. So I'll do this from scratch. It's like the first time we covered Coca-Cola HBC. But I'll just start with what the company does. So they've got an investor presentation. So they are the largest franchise bottler of Coca-Cola trademark beverages in the world in terms of volume. They serve over 266 million people with 2 million points of sale, 49 bottling plants and 260 distribution centres. Their volume is 3.7 billion units as of Q3 2022 when this investor presentation came out. And their operating cash flow typically hovers around 19%. In terms of the countries they operate in Mexico and Central America, which is made up of Guatemala, Nicaragua, Costa Rica, and Panama. And then they're in South America too. And they operate in Venezuela, although the Venezuela operation is reported as an investment in shares, so as a non-consolidated operation. So they just own shares in the Venezuelan one, which I think when you look at how Venezuela's doing as an economy, it's probably not that relevant anymore. But they've also got Colombia, Brazil, Uruguay, and Argentina. So it's basically Coca-Cola for Central and Latin America and Mexico as well. I don't know if you'd count that as Central America or not. Anyway, they have. You would?
Yeah.
I don't. But you call it, it's in the continent of North America, isn't it? Some of it.
Okay. We'll
it's
move on.
One for the philosophers. Maybe we'll never know. But anyway, what we do know is that Coca-Cola FEMSA have come out with their full year results, and consolidated volumes increased 8.6%, driven by volume growth across all territories, including double-digit growth increases in Brazil, Colombia, Argentina, and Guatemala, coupled with a solid performance in Mexico and Uruguay. On a comparable basis, excluding mergers and acquisitions, volume increased 7.5%. Total revenue increased 16.4%, while comparable revenues increased 17.8%, driven mainly by our pricing initiatives, favourable price mix effects, and volume growth. These factors were partially offset by a decline in beer revenues related to the transition of the beer portfolio in Brazil and unfavourable currency translation effects. Operating income increased 12.5%, while comparable operating income increased 11.6%, driven mainly by solid top line and operating expense efficiencies. These effects were partially offset by higher raw material costs, coupled with a tough comparison base that includes the recognition of non-recurring tax effects in Brazil during 2021. Majority net income increased 21.2%, resulting in earnings per share of PS. What's PS?
Pesos?
That's what I'm guessing. 1.13, and that's up from 9.06. And the Ian Craig, the CEO, he said quite a bit, but the main thing that I found interesting was he said 2022 was a positive year for Coca-Cola FEMSA. In the face of inflation of an inflationary environment, our company was able to deliver its highest ever top line operating income and operating cash flow levels. To me, that just reads, this business is pretty inflation proof. No, genuinely, because it's just such a strong brand. Whatever inflation is, that's what it's going to cost you extra for your Coca-Cola, and people will just pay it. In terms of the stock price, the stock's up 47% in the last year, and that compares to a 12% decline for the S&P. It's up 97% for the last 3 years, and that compares to a 54% increase for the S&P. and it's up 22% in the last 5 years. That compares to a 50% increase for the S&P. In terms of revenue per share, between 2007 and 2022, revenue per share has increased from $34.28 to $54.15. So it's not amazing growth, but it's pretty steady, plugging away every year, probably in line with inflation or slightly above, plus whatever the growth of the population is in Latin America. Earnings per share in that period, 2007 to 2022, is up from $3.42 a share to $4.55. So not amazing, but again, it's fairly decent. And free cash flow is up from 3.22 to 5.28 in that period. It trades at a market cap of $16.5 billion, and it trades at a PE of 16.19 and a forward PE of 15, and that makes it 0.7. This PE is 0.77% or 77% as expensive as the S&P 500, so it's 23% cheaper on a PE basis. Okay, so it's paying about a 3% dividend yield as well. So my view is, I think these are fantastic results, but based on what we've seen from 2007 to 2022, I wouldn't expect results like this every year. However, I like the business. Same reasons that I like Coca-Cola Hellenic Bottling Company. I like it gives you good exposure to some parts of the world you might not ordinarily have that much geographical exposure to in your portfolio. But with one of the best brands in the world, this probably isn't going to be a business, that's going to be delivering incredible returns. But I think, it has done very well, and I would expect it to do well. And it's not that expensive. I think at a PE of 16, especially considering where it's listed, I think that's pretty cheap. It's not that dissimilar to Coca-Cola Hellenic Bottling Co. I think that's usually about 15. So no, I like it. And I think it's a really interesting play on Latin America. If you wanted it, but didn't want that much risk, you just wanted the exposure to it. I think same reasons I like Coca-Cola Hellenic, I think apply to this. What I almost half expected with this was I felt like I knew what the results were going to be like, and I knew it was going to be good. But I then expected to see P of 30, which hasn't happened. John, what are your thoughts on the results and the valuation?
No, like you say, I think it's a fair valuation for an area of the world that's growing a lot. I would probably consider buying, certainly putting it on the watch list alongside Coca-Cola HBC, and a little bit of a basket approach in that you'd be accepting that they're emerging markets, they're a bit more volatile, but having exposure to both or both geographies with that Coca-Cola brand, I think that would seriously, I would consider that.
Would you consider throwing in the Asia Pacific one, or are you not as bothered because it's probably not going to be as much of a growth market?
Possibly. I would go back and have another look at that, I think.
I can't remember what the valuation was on it.
Yeah, I'd go back and I'd have another look at it. These ones definitely I like. But no, the Asia Pacific I'd consider. But these two are like...
Not Daddy Coke because of valuation.
Oh, I mean, I'd love to own Daddy Coke. And probably, I mean, I'm sure you could say it's for the loss of businesses, but that dip you had after the pandemic, yeah, I wish I'd bought them.
Coulda, shoulda, woulda.
I know, exactly. And we can't, you can't invest like that. But I would love to own Daddy Coke one day.
Okay, so of the 6 businesses we've covered this week, Fevertree, Keyword Studios, Inditex, Helios Towers, Kingfisher, and Coca-Cola FEMSA, if you had to buy one, which one would it be?
It's tricky, actually. I would probably go for Coca-Cola FEMSA, but a close second would be Keyword Studios, I think.
I'd go with Coca-Cola FEMSA as well, without sounding boring.
Yeah, tricky, but I do like keywords, and the more we're covering it, the more I like it. But also you cover it and you see the results, and it's delivering them, and you think I should have bought it last time. So we might have to put an end to that and bite the bullet with it.
Right, well, thank you very much for joining us, and we'll see you next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at @TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.